Once you've got a potential business and you've proven that there's a business model for it and it's working. Second is find an investor, which we all know that too well. And really, what he's saying is, even if you've got to scale a big business, you're probably going to require backing. It's very rare that you find a business that can get to that level that doesn't require investment. And they won't. What he says is, investors will not save you. They won't save a broken business model, but they will accelerate your business model, whether it's successful or not. So if your business model is broken and you put money into it, it will accelerate the the demise on a much larger scale. If your business model is sound and you put money into it, and technically it should accelerate the success of it. But
I've got a good analogy for you, Dorian, which is passed down from my non-exec advisor. He said, when the numbers get bigger, it's like driving a faster car. Problems come at you quicker.
yeah,
Yeah,
that's
car analogy.
Love that car analogy.
Yeah.
Love
Vroom.
Vroom. How much do you pay that non-exec director?
Oh, about 400 grand a year. He's worth every
You
penny.
might want to review that, my friend. But
Yeah. He's a terrible backseat driver.
but the key thing, what he says is, so yeah, investors will not save you. Investment is about early collaboration. It's about collaboration, and make sure that you invest money when you don't need it. So that's all about forecasting. That when you're on the back foot and you go for money, it will be very difficult to get good terms. So what do you guys think about that?
I mean, Brian?
absolutely.
Yeah.
Absolutely. Couldn't agree more.
Yeah, I agree. I think the investment's like fuel, right? Like Jack said, it's the more you get, the more you can spend. You burn through it faster, and you need to have a plan. Effectively, the cash should just buy you more business. Like you said, it should just increase and scale up. The more investment you can put in the front, the more cost per customer you can spend. The more customers you're going to have, the more you're going to turn into sales, and then the business will grow that much quicker. But you need to have the infrastructure there first. If you just burn through cash, we're not having the team in place.
You'd say though, wouldn't you, that there's kind of an intermediary phase, and I think Richard has gone like to big steps, but there is that intermediary phase of like you might copy, pivot, or find a good business model, but you need to get what's product market fit, what is something that can actually be scalable, that is worth bringing investment into. Whereas there are a lot of entrepreneurs who start a business, and especially in tech, and they'll get investors and throw money at it before they even know how they're going to make any money. But that's because they're going for TAM. They're like, tech's going for TAM. They know if they just get the market, they'll figure out the monetization later. But in analog businesses, sometimes you just can't afford an investor in it because your model's just broken or something fundamental about it, or it's very price driven or margin erosion or whatever. So I do think different businesses have a lot of intermediary steps that might miss out.
I was just going to play devil's advocate with this statement.
You can do that because I'm just going to circle back to not like this finding investor, but I was going to come back with a question about the mindset people need, because you guys have seen this. I've seen it and spoke to people. People want a business and they want to scale it, but there are two camps. There's those camps that don't want to raise money or are scared of doing so, and want to try to do everything without it, which is obviously commendable, but very, very hard. And there's those camps that will take risk and will work with investor. And I was just going to read a couple of passages from here of the type of like risk appetite Richard had to take. Because remember, this book is about large scale, getting to a larger scale business, not necessarily a lifestyle business. There's nothing wrong with that at all. But this book is about building a big business. And what he's saying is, to do it, you need to find an investor, but also his risk appetite for the business he had. And what he's saying is, try not to let it get like this. He had to at one point, try to secure 15,000 at 20% plus interest. He had to negotiate on the back foot. Somebody offered him only £15,000 for 10% of his business. They ended up having to sell a 50% stake in the business for only like 200,000 because they were all on the back foot. And to get to that point, he'd maxed his own personal credit cards out and was just genuinely down to his last pound personally and the last money left in the business bank. So he basically faced both business ruin and personal bankruptcy to get to that point. So that his risk threshold was obviously very high, to commit to that. What do you guys think?
Yeah, concur.
Sounds like me at times.
It's difficult because I know that everyone on this call has been like, fuck, we're up against it now, and had to really be on the front line and, you know, do the heroic run out the front line first, shooting, know that you could
Yeah,
be shot and you
chanting.
might
Yeah,
game over. Because the thing is, when you're in that position, you're like, this is horrible, but you don't know what you could have changed to not be in that position, because the position you're then in is as a result of something you haven't is out of your control, or something happens, or you have to pay a bill that you didn't realize was going to crop up, or whatever it may be. So and it does get quite exciting, doesn't it, when you're really up against it?
Pressure.
that's the thing, isn't it? And I do find that if someone finds one of those holy grail businesses where it scales at such a high pace with its own working capital, I mean, you know, congratulations, what a business. But in my experience, that's so rare that typically to scale a large business, you have to take on money, whether it's equity or debt, and your risk perception changes. And because you're scaling a business and pushing boundaries, you're not going to make every decision correct. And as Jack said, you will sometimes end up in a poor place, which is always technically temporary, uh, but it's because you have to decide, and you're not going to be right all the time. And then it's like, how are we going to get out of this? And if I list some of the things we've done in this business to get to where it's got to and further, if I listed those out when I started the business, I would have said, "There's no way I could do that. No way, that's not going to happen." But you
A lot of you
just
would have started.
It's
There'll be the problems at the
is
start.
your friend.
Yeah, you just got to go for it. And then go fuck and don't get burnt. And if you get burnt, change direction fast, learn from it, and don't do it again. We've got a non-conformance process at Skyloft. So every time we spend £1 over what we shouldn't have spent on something, we write it down, and then we go out for lunch every 3 or 4 months and talk about those. If it's £1 or if it's 10 grand or 30 grand, and we'll go, right, what the fuck happened? No blame culture. What can we do to stop it happening again? And it takes years and years and years of discipline to do that, to try and put out the fires. Because another thing with lofts is that it's a one niche product, where general construction, that list is endless. You can spend money pouring it into the ground, pouring it on brickwork, demo work, structural work, where at least with lofts, there's only 1,500 things that can go wrong, not 15,000 things. So it is more manageable.
Property is interesting in this way, though, when it comes to the investor question, because you have like a unique ability in the model to be able to sort of fractionalize the business and steroid inject it with investor capital while still keeping 100% ownership of the inherent brand structure, which isn't really possible in most businesses because of IP, because of like sharing resource. Whereas in property, you kind of get this other layer of capital movement, capital raising that can really grow the business. You still got fundamental principles within that business and overheads and stuff like that, but I do think it's quite unique in that way. And it's one of the big reasons I like property, because if you're good at raising money, you can exponentially scale quite quickly, where you can't in a business where the money you introduce just might kill the business because of too much run rate or too much expensive capital or expand too quickly. You can't really do that in property in the same way. You could deliver capital quickly in property and quite simply.
Yeah.
Just to point that out.
Okay.
Talking about giving away, you said he sold 50% of his business or 10% of his business when the same non-exec with the car analogy always says, when you don't want to, you've always got to give away the crown jewels. But I've got a story of that. A guy I went to school with, his mum was telling me a story. They lived in central London in a tiny one-bedroom flat, and they would rent out the one-bedroom because they were skint. They would rent out the room to a young tech guy and actually live in the main living room with their son, who was my friend. And she told me a story that they were really hard up for money. Essentially, the lodger couldn't afford to pay them rent, so she sort of gave him a bit of an ultimatum and said, "Look, you pay rent or you're out." Because he couldn't afford to pay rent, he offered equity in this project that he was working on, and she rejected it, kicked him out. Well, not kicked him out, but said, you got to move, and got someone else in that could pay rent. And it then transpired that the person in that room was the owner of Siemens that became Fujitsu Siemens. And she was like, if we would have took that, we would have been in the money. Coincidentally, they became super successful anyway. The family did. So it's kind of like a fun story within the family, but interesting to say the least.
That is fun.
That is very hard, isn't it, to know the correct thing to say, to what to do? Because there was what was it here? I just remembered, as you said, in 2005, graffiti artist David Choi was hired to paint murals at Facebook's first offices and was offered a choice of $60,000 in cash or stock options for his work. He took the shares, which grew to over $200 million on the company's IPO, because this was
Wow.
pre-IPO. So that there was, it's very hard, isn't it? Because most people, us too, because we're so pushed advantage all the time, we always require cash now to do something with it. So when the opportunity comes around, it's like you either have cash now or you don't, and you're into this. It's when you're always like, oh, but I really need that cash now.
It's the best form of negotiation is being able to walk away, and often being able to walk away is having another option. So if you're like, well, we could just do this instead. Yeah, completely agree. Right, let's go.